Let's be honest, the world of finance can feel like this huge, confusing maze, right? It's full of jargon and invisible rules. But what if you could actually understand your money's journey, from the second it hits your account to how you can make it grow for you? Well, in this explainer, we're going to give you the map. Have you ever looked at your paycheck, seen that nice, big number at the top, and then looked at what actually landed in your bank account and just felt completely baffled? This quote just nails that feeling. It's that moment you realize a piece of your hard-earned cash has kind of vanished. Today, we're going to pull back the curtain on those invisible forces. So here's our game plan. We'll start with the basics. What actually happens to your money from your paycheck to the bank? Then we're going to uncover the invisible price tags that are always there, interest and inflation. After that, we'll decode your financial reputation, figure out how to ride the economic waves, and finally get to the fun part, how to put your money to work for you. All right, first up, let's trace the journey your money takes, starting with the one thing we all experience, getting paid and putting that money somewhere safe. Okay, so picture this. You earned a $2,000 paycheck. Awesome. But as you can see here, you only get to take home about $1,456. So where'd the rest of it go? Well, it got sliced up and sent off to cover federal and state taxes, Social Security, and Medicare. This is that modern ritual in action. So what's the point of handing over all that cash? You can think of taxes as your subscription fee for living in a functional society. It's what pays for the roads we drive on, the schools, all that stuff. Social Security is basically a forced savings plan for your retirement, and Medicare is a health insurance tax to support older folks. Now, once your take-home pay is in the bank, you might imagine it just sitting in some giant Fort Knox-style vault with your name on it. But that's not really how it works. See, banks operate on a system called fractional reserve banking, which means your money is pretty much always on the move. Here's the simple version of what happens. You deposit $1,000. The bank only has to keep a small piece of that, maybe $100. It then loans out the other $900 to someone else, someone who's buying a car or starting a business. The bank makes its money from the interest it charges on that loan. So your money is constantly in motion, out there powering the economy. And this whole idea of lending money out and charging interest, well, it leads us perfectly into two of the most powerful and often invisible forces in all of finance: interest and inflation. These two are constantly shaping your financial reality, whether you notice them or not. Interest is, no joke, a double-edged sword. On one hand, when you're paying it, like on a credit card, it's this relentless force that works against you 24/7. But on the other hand, when you're earning it in savings or investments, it becomes your best employee, a personal money-making machine that never clocks out. And this is where the real magic happens. We're talking about compound interest. This isn't just interest on your initial money. No. It's interest on your interest. It is, for all intents and purposes, the financial equivalent of a cheat code, and it can massively accelerate your wealth over time. The other invisible force is inflation, and you've definitely felt this one. Ever feel like you're paying more for less? Like when you open a bag of chips and it feels like it's mostly air? That is inflation in a nutshell. It's like a silent thief that slowly eats away at your money's value. Your $5 bill is still a $5 bill, but it buys you less than it did last year. So what's actually causing this? Well, a few things. Sometimes it's a classic case of too much money chasing too few goods, which drives prices up. Other times, you have supply chain problems that make everything more expensive to make and ship. And fascinatingly, sometimes it's just a self-fulfilling prophecy. We all expect prices to rise, so we spend our money faster, which, you guessed it, causes prices to rise. All of this, borrowing, lending, paying things on time, it all boils down to a single number that has a massive impact on your financial life. Let's talk about your financial reputation, or as you probably know it, your credit score. So your credit score is this 3-digit number, somewhere between 300 and 850. But here's the most important thing to get. It is not about how much money you have. It has nothing to do with being wealthy. It's all about trust. It's a lender's quick way of asking, hey, if I lend you money, can I trust you to pay it back? So how is that trust calculated? Well, it's a mix of a few things, but just look at the biggest piece of this pie right here. By far, it's your payment history. I mean, it's huge. It really just comes down to one simple question. Do you pay your bills on time? Other factors matter too, like how much of your available credit you're using, but nothing matters as much as that. This analogy is just perfect. Your credit score really is like a pet. If you ignore it, it can make a real mess of your financial life. But if you take care of it, nurture it, it can become this powerful ally that helps you do huge things, like buy a car or even a house someday. Okay, so let's zoom out for a minute. Your personal finances don't exist in a vacuum, right? They're part of this much larger economy that goes through cycles with its own ups and downs. So let's talk about how to navigate those downswings, also known as recessions.
Honestly, the best way to understand the economic cycle is to think of it like a party. The boom is when the party is raging. Everyone's dancing. Jobs are easy to find. The peak is that moment the lights flicker and you realize things are slowing down. The bust, or the recession, that's when the DJ's playing sad music and the party's over. But it's not the end. Eventually there's a reset, things start to recover, and the whole cycle begins again. So, with all of this on the table, taxes, banks, interest, inflation, these big economic cycles,
How in the world do you actually get ahead? This brings us to our final, and frankly, most empowering section, putting your money to work. Investing is your number one weapon against that silent thief, inflation. It's the crucial shift from trading your time for money to trading your money for more money. It's how you finally make your cash start working for you instead of the other way around. So, how do you do it? Well, the most common paths are through stocks, which are tiny little slices of ownership in a company. There are bonds, where you're basically loaning money to a government or a big corporation. There are funds, which are just big baskets of different stocks and bonds. And of course, there's real estate. Now look, I know what some of you are thinking. Investing sounds risky. And you're not wrong. Markets do go up and down. But there's a much, much bigger risk that people don't talk about enough. The risk of doing absolutely nothing. The real danger is letting your money just sit there while inflation silently eats away at its value, year after year after year. And that brings us to the most important ingredient in this entire recipe, time. This quote says it all. Building real, lasting wealth is a marathon, not a sprint. It's not about getting lucky or timing the market. It's about being consistent and patient over decades and giving that cheat code, compound interest, the time it needs to really work its magic. So we'll leave you with this one thought. Your money is always working. The invisible forces of interest and inflation, they never sleep, they never take a day off. So the real question you have to ask yourself is this: have you put your money to work for you, or is it slowly but surely working against you? The choice is yours.